Hey guys, welcome to my mini lecture on comparative advantage and PPFs and all that stuff. I'm just going to try to give you some context here on what these models are about and why we care about them. I've already made a couple of videos on production possibility frontiers and comparative advantage and finding a mutually beneficial trade deal, so I'm not going to get into the technicalities. I just want to put these things in context. We create PPFs as a way of simplifying reality, same with any model, and we want to get some idea of people having scarce resources. The PPF can apply to a person, to a company, to a country, to any group you want, and they have to choose how to use their stuff. And we simplify it to a decision of two goods. I'll be honest, in a lot of books, the examples are really absurd, like I can make strawberries or iPads or something ridiculous, but deal with it. It's fine. You can make up a realistic one if you want to and blow your teacher's mind with it. But anyway, we have scarce amount of resources and we can make one of two goods. When we alter our production decision, maybe to make more strawberries and less iPads, we have to give up a certain amount of iPads to get more strawberries, and vice versa. That is called opportunity cost. Opportunity cost is what you have to give up to get something, and that's a lot of what the PPF is there for. Is to help us measure opportunity cost. Once we do that, we can compare two different people, countries, companies, whatever's, two different production possibilities frontiers, and see that different people will have different opportunity costs for the same good. For instance, I might be interested in hiring an electrician to fix up some problem in my garage. And maybe I could do it myself, but I've determined it would take about $500 of my time to fix it because I don't know what I'm doing. And I'll probably have to spend a lot of time on YouTube and hopefully not electrocute myself. The electrician, who's been doing this for years and received a lot of training and experience, can maybe do it with like 90 bucks of their time. The fact that it costs me 500 to do it myself, costs the electrician 90 to do it themselves, means that there's room for a trade. I'm willing to pay anything below $500. The electrician's willing to charge anything above $90. And so anything in between benefits both of us. So when we start to look at these and we start to measure the opportunity costs, we can start to think of it almost in terms of trade prices. Not like direct prices, but just giving us a range of what's acceptable. If it costs me $500 of time to fix my garage and it costs them $90 of time to fix my garage, then any price between 90 and 500 helps us both. That's kind of the general idea of what we're going for here. And again, check out the follow-up videos. You'll get some more details on it. The goal then of a society that wanted to maximize its production and consumption would be to have everyone specialize and trade. Both parties in the market will specialize in the thing they're good at. And if we all make the things we're good at making, the things we have comparative advantages in, there will be more of everything in this economy. And then we can trade. And if we do, it's possible for us to have higher consumption than if we were to act without trade. And so that kind of leads us to the idea that we have a market economy. Buyers and sellers from all over the place come to each other to trade. We buy stuff, we sell stuff. And buried behind it is always this idea of comparative advantage in trade. I have a certain willingness to pay for my products, which is limited either by my resources or by my enjoyment of the good or by my own cost of producing it myself. And sellers, they have a cost of producing it. And anything between my willingness to pay and their willingness to sell, or their cost, benefits both of us. And in a market system, we let people, buyers and sellers, find each other. So now we've established how trade can benefit people. I should probably put one of these up here because these circular flow diagrams are often shown in the same chapter as the comparative advantage in trade. You'll probably learn about it at about the same time. There's not really much to it. It just gives you some idea of how interconnected our economy is. There's households and there's firms, and they interact in two different markets. The households, people like you and me who live places in like a household, we can go to a product market where we buy goods and services. We buy things, and there's a firm who creates and sells those things. So when we buy it, we receive the good and service, they receive the money. There's also factor markets. In these ones, the households are usually treated as the suppliers. For instance, in a labor market, workers produce labor. They're the creators, and they sell it. Firms want to buy the labor, and so they pay you for it. And so when in a product market, money goes to the firms, but in a factor market, money goes back to the workers. And that money goes around and around. I work so I can get paid, so I can buy stuff. When I buy stuff, they get money and pay for workers. So with all of this idea of these interconnected markets, what are we trying to do? We're trying to show you that the economy is connected and that people will make trades when it benefits them. And that if we have a market system, buyers and sellers can both benefit from a transaction because they have different opportunity costs. If we can hit a price somewhere in the middle, they'll both be willing to do it and they'll both be better off for it. And of course, there's a little more we could get into this. We could talk about the need for good entrepreneurship. We need people to be able to organize the companies and make the production process work. And in order to have that, you also need a good legal system in place that establishes property rights and lets businesses protect their own stuff. And if we have that, then there's incentives for entrepreneurs to start making stuff. And then there's a supply side in your market. If there's a supply side in your market, then people can buy stuff in all these ways we've already discussed. So I don't know if that's helpful to you or not, but maybe it is. I thought it was some good background information for behind the purposes of the comparative advantage and PPF stuff. Go ahead and check out the next videos to see what it's all about. There's a lot more technical discussion in there. Good luck, you guys, and happy econing.